Is it better to seek alpha or to seek dollars? This is Bill Scheid from Applied Finance Research, and that's the question that we're going to answer in this video. So to start off, I'm going to give you the short answer up front, and then we're going to dive into some details. So the short answer is this: it's really a question of objectives. Neither is right or wrong, and of course, our individual objectives are going to vary from trader to trader. There are pros and cons for each approach for seeking alpha versus seeking dollars with our trading, and we're going to dive into those next. So let's start off by talking about some of the pros of seeking alpha. So first of all, this can be very important if you are managing money for clients. So if you are a hedge fund manager or some kind of other public money manager, this can be really important because to be able to say that you're beating the market is certainly a great marketing tool and could attract a lot of clients for you. There's also the potential for high returns when seeking alpha. However, one of the cons of seeking alpha is that there's also the potential for higher risk. And the other con that I find is the subjectivity of which market you're going to choose as your benchmark for comparison. Many people like to choose the S&P 500 as their benchmark, but few people can tolerate the 50% drawdowns that would come with just putting your money in the S&P 500 and letting it ride. So it's maybe not always the most practical choice or realistic choice. 60-40 could perhaps be better for some retail investors, but again, that's a can of worms, and that is one of the cons of the seeking alpha approach. Which benchmark do you choose to use? So let's talk about seeking dollars and some of the pros there. So first, one of the big pros is you can't pay your bills in units of alpha. So paying attention to the actual dollars that you're making is quite important. The second is that if you have a practical use for your capital, like retirement or college, you can create objectives around compounded annual growth rate and maximum drawdown, and then you don't have to worry about short-term market stats. Did you beat the market this year? Did you not beat the market this year? As long as you're hitting your objectives for growth and drawdown, you're on your way to meeting your long-term practical goal. One of the cons of seeking dollars is that there could be a possible lost opportunity cost if an alpha seeking approach could provide a greater return than what you're doing at equivalent levels of risk. Now, for me as an individual trader, individual investor, I'll share with you what my personal view on this is for my own trading. This is not recommendation, not advice. Your mileage may vary, your objectives will vary. I prefer to think about things in terms of compounded annual growth rate and maximum drawdown. And the reason I like to do that is because my objectives are around specific uses for my capital over specific timeframes. And I'm also very mindful of maximum drawdown because I know that the psychological impact of experiencing maximum drawdowns can affect my ability to properly execute my systems mistake-free. I don't so much worry about the lost opportunity cost, and that's mostly because the monthly systems that I'm using and that I'm teaching they often have a performance that's similar to or better than the S&P 500, and often on drawdowns that are less than the S&P 500 and sometimes even less than 60-40 approach. So sometimes with an appropriately crafted and designed and well-researched system, you can actually have your cake and eat it too. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.